We've also heard some offer the opinion that you can't look at stocks long-term anymore, and buy and hold is dead. That was kind of a big theme with a lot of the pundits. But could you just take a moment and tell us, when you're considering a stock for inclusion in your portfolio, what type of time horizons do you look at, and what kind of expectations do you have for individual stocks that you're recommending or you're buying for the portfolio?
Sure. We look at a 5-year time horizon. We're modeling out each of our companies' 5 years worth of results in terms of revenue growth, profit margins, cash generation, putting an appropriate terminal multiple, and using a discount rate to discount the cash flows at an appropriate rate for the risk of that company. But we do everything on a 5-year time horizon, which is I'll say it's based on some other investment firms I've worked with over the years and people I've talked to. That's not necessarily the norm. But just one thing that in terms of how we look at that time horizon for our investment team incentive compensation, every quantitative performance-based aspect of our incentive compensation is based on 5 years of our investment results. So there's nothing in our incentive compensation goals that's on any time frame shorter than 5 years. So that's how we look at companies, and that's how we look at our investment results. And in terms of just in terms of what we're expecting, what we're trying to get out of a stock, sometimes people ask us, what kind of margin of safety do we require to invest in a stock? And that margin of safety changes. In an environment like today, we're finding it difficult to find a lot of opportunities that have more than a 10 or 15% margin of safety. And if we're using a required rate of return on stocks that might be, say, in the 8 to 12% range, and we have a 10% margin of safety, that means that we're hoping to get, over 5 years, an annual return of maybe 10 to 15% on an investment we make. If you go back, just to put that in some perspective, if you go back to, say, a month after 9/11 hit, our CEO sent a note to the investment team saying, if you have a stock in your portfolio that's trading at a 20% margin of safety, you need to sell it, because there's so many opportunities that are at 40 to 50% margin of safeties that 20% just isn't enough. That's more the environment that we had in the first quarter of last year, where there were a lot of opportunities that were at 40 to 50% or higher margins of safety versus our estimate of what the companies were worth. Today, as I said, we find some areas, some energy holdings and some other individual investments that we think are good long-term investments. I'll just add one thing. Warren Buffett has said in the past that when you make an investment, you should be happy if they just shut the stock market down and you just walk away and you come back 10 years later and find out how it worked. And that's definitely our approach, is that we make an investment. We're saying that we'd be happy to invest with this company and participate in their growth over 5 years or longer. And that doesn't mean that we don't have turnover in our portfolios. We do, because sometimes the market is rational, sometimes it's irrational, sometimes we discover that our estimates of value were wrong. But we try to make every investment viewing it as we may be holding this for 5 or 10 years or longer, and I think we've had some success with that.